And we should be live. Welcome to Falfa Money. I'm Falfa Money founder and your host, welcoming you here for another quarterly update with our good friend of the program, Job VanEck. Job, how are you doing?
Great.
Great. Now, most of you watching, I'm sure, have heard of the VanEck family of funds. You probably own them, I imagine, in your portfolios. For the very few of you that may not have watched Job on this program before, he's the CEO of VanEck. It's a highly respected investment company with over 116 billion in assets under management. They offer a huge variety of different funds and investment vehicles across a whole bunch of asset classes, particularly in the alternative asset space, but they're really everywhere. And we have just gotten incredibly lucky on this program to have Job, the CEO, come on this channel at the start of every quarter to share his quarterly outlook with us. So Job, we're going to talk about Q3 2025. Any buzzword that comes to the top of your mind about how this quarter may differ from the previous few we've just lived through?
A little blindfolded.
Okay.
A little hard to tell what's going on, but let's get into it.
All right. Well, look, as usual, you have done all the advanced work for me and put together a great presentation. Should we just kick that off?
Yeah, let's go. So, the title of this is, I've been talking about the 3% reckoning for about a year right now. And the context for that is that the U.S. budget deficit is unsustainably high. That it has explained a lot of what's happened in the markets. The high level of government expenditures explained why we didn't have a recession after the interest rate hikes of 2022. So it's really one of the largest forces in the markets. And we knew that a new president would be elected, and usually major fiscal policies are addressed the year after a presidential election. So the question is sort of what's the play out of that? It's a little bit unclear. I feel like we're in the middle of the eye of the hurricane, but let's talk about some of the things that are super clear. So first of all, even though the 10-year hasn't been affected by the budget deficit, the best performing assets, Bitcoin and gold, I think have been beneficiaries of the big spending and reducing confidence in the U.S. dollar. So that has helped portfolios dramatically, and we'll drill into that a little bit. There's a lot of things that have happened in the first half of the year with respect to AI that are really going to be playing out in the markets and with employment over the next couple of months and years. And then, a lot of changes we've talked about, my high conviction view that India in 10 years is going to emerge as the fourth largest consumer market in the world. Let's look at how that's playing out in the markets, because that's not covered a whole lot in the US. So I'm going to dive right in. Basically, I'm not going to go through all the text on this slide, Adam, but as you know, kind of our view at VanEck is that the financial markets are affected by major events in the world, namely technology, and then politics and economics. And so a lot of times in history, like the emergence of China was affecting portfolios before the creation of an asset class called emerging markets, or gold and Bitcoin were great buys before they became mainstream investments in 1968 and in 2017, respectively. So that's kind of how we look at it, that the market cap way of looking at the world doesn't always reflect the full set of opportunities and what you should be doing with your portfolio. So just to put that in context, a year ago, Adam, I don't know, I hope you remember, I basically was calling to sell growth stocks. And the reason for that is I love multi-decade charts. Jan loves multi-decade charts. So here was a multi-decade chart that showed last summer growth versus value had hit the same peak as at the peak of the internet bubble in 1999. So that and the next chart, which shows S&P equal weight at a low, the same also as 1999, both indicated that growth stocks were overvalued last July when we were sitting down literally a year ago. And so that turned out to be correct. We'll talk about that a little bit later, but it's that multi-decade perspective that bringing to the markets right now. So I did say that we're a little blindfolded right now, and I wanted to explain that a little bit. I'm going to talk about just a quick recap on the federal budget deficit that we've talked about before in prior quarters. And but it's really hard to know what's going on with that deficit. So we'll talk about that. There's some really bad numbers in the headlines in terms of percent of GDP, but let's just plug into that. And we know that some of those numbers are flat out not going to be reliable. Then, the employment, we have an unemployment stat today that showed good labor market, but we've got these big pressures. We know that AI is going to, at some point, affect the labor market. At the same time, we have this offset because illegal immigration has literally gone to zero. So you have these countervailing forces. And I think if we look at the second half of the year, Adam, we're going to be surprised by a statistic, whether a very strong employment number or a very weak one. But my point is there's going to be a lot of noise, and not to overreact to a couple of headlines. Inflation, again, something else has two conflicting forces, tariffs driving it up, but then technology driving it down, goods inflation, energy prices are low, but services are sticky. So again, a mixed story, hard to tell what's going on. And then we know the economy is slowing a little bit, Adam, but profit growth was good in the second quarter. I think that will continue to surprise, and I'll explain why. All right, budget deficit, I don't like it. I think we should own gold and Bitcoin in our portfolios, and that has played out fantastically well so far in 2025, right? Bitcoin is up 14%. Gold bullion is up 26%. These are 12-month stats, so I'm just giving the year to date. And gold shares up 54% in the first half of this year. So if you believe the story that this is a major thing happening in the markets, and you had your portfolio hedged by owning some store value assets, you're extremely happy in the first half of this year. Let's just look at some charts. Gold here, when we talked a quarter ago, Adam, I was a little worried about the gold price had run ahead of itself. And you see here how it's gone way ahead of that line, which is the 200-day moving average. And I was expecting some kind of sideways movement. I'm going to redouble down on that bet. I love gold, but I just think it's got we're in a seasonally weak time of the year, and I just feel like it's got to catch its breath a little bit. So maybe not great expectations for Q3. Who knows? These short-term things are just kind of feelings, but that I will continue that kind of feeling. And then Bitcoin is, I would call it, a little bit better behaved here. We're expecting all-time highs in the second half of the year, so still holding on to that as a hedge. Here a bunch of stats, which is really a chart crime, so I apologize in advance for that. But it basically shows that the Bitcoin has been doing well over almost every time period against the NASDAQ. And then we do have the cautionary chart that Bitcoin correlation to the NASDAQ has been higher since COVID. So a little bit less appealing maybe than gold as a diversifier, but still has been performing well. So let me at least, before I take a pause, let me just finish this section, Adam, and revisit some of the budget stats that we talked about. So here's the crime. The blue line showing that our budget deficit as a percent of GDP is hovering in the 6 to 7% range, even though unemployment is very low, right? So this is a time we should be saving. Instead, we continue to spend. What the exercise that we did is to look at the last fiscal year, which ended September 2024. There's a lot of noise in the current fiscal year because you have both the Biden and Trump administrations. And what we're trying to project is for the fiscal year that starts on October 1st. And we did this game of trying to figure out, could we bend the curve and take this budget deficit from 6.4% of GDP down? So this is a little bit of an extremely crude bit of math, but I wanted just to I haven't changed the numbers. So optimistic Jan on budget cuts was maybe we could get to 875 billion. And this broken out this way: 125 from shrinking the federal workforce, 100 billion from waste, fraud, and abuse, tariffs, 250 billion in additional tariff revenue. We already get 80 billion or so. And then cutting IRA, which is the energy Green New Deal, raising some miscellaneous taxes, 55 billion, cutting from the Pentagon, Medicare, Medicaid, 200 billion, and then I added a new line of Trump goodies that have been thrown in. So no tax on tips and that kind of stuff. So the report card so far is that they have not reached those goals. So we are not bending the curve. And I guess the best guess is somewhere the deficit doesn't change at all at 6.4% of GDP, to maybe, in the best case, we bend it down to 4.5%. And most people would say I'm absolutely nuts to talk about getting the deficit down to 4.5%. But let me just go through those assumptions. So DOGE has only been able to cut about half of the 125 billion. Waste, fraud, we have no visibility on this whatsoever. So this is government contractors and things like that. I'm going to give the administration full credit on cutting those cuts. We don't have any idea. Tariffs at 10%, I think we're pretty close to my $250 billion number. But I want to point out at this point, Adam, that the tariff number is not included in the official calculation of the federal budget deficit. So nothing you see in the newspaper from a politician or anything points that out. So it's literally cash into the coffers of the federal government, but it's not counted for these budget deficit calculation purposes.
True. Yep.
So anyway, you can just sort of see here, bottom line is less, even if I'm giving them credit for stuff that we don't really have visibility on, budget that was still pretty high.
So let me ask you this, Jan. And first, I should have said this at the very beginning, folks. If you haven't figured out already, this is actually a live stream here. So if you're watching here at you started watching at 11 a.m. Eastern, you're watching the live thing. So once Jan gets through these slides, we are going to take some live Q&A from the audience. So folks, if you do have questions as Jan is presenting, ask them there in the live chat, and I'll pull from them later on when we get to the Q&A. So Jan, not looking great yet that they're going to get down to that 3% solution. That being said, I've heard Treasury Secretary Bessent mention 3% as the goal. I mean, as recently as like this week. And I think from what I'm hearing from the administration is they expect it's going to come less from cuts and it's going to come more from growth. So you mentioned the tariffs; they are not in the CBO scoring when they calculate the deficit and whatnot. So that's some upside there. But of course, there's a lot of things from deregulation and better trade deals and all sorts of other things that the administration is hoping is going to dramatically boost GDP growth. Maybe not as much so in 2025, but hopefully in 2026. What level of confidence do you have on the growth side of getting the GDP, the deficit as a percent of GDP down towards that 3% target?
I mean, I don't build that into these number assumptions for the next fiscal year, Adam, because the reverse is true. If we have a slowdown in the economy, forget these numbers, right? The deficit will blow out. And, in the prior quarter, we looked at those numbers and the budget deficit grows from something like 2, 3, 4% of GDP. So all these safety net programs like Medicaid, Medicare, the expenditures will go off the charts. So that's why I didn't make that assumption. If I had to answer your question, I find it hard to think that although there is a lot of positive signs on deregulation and things like that, it's hard for me to think that it's going to get GDP growing dramatically faster, like 1.5% faster. That seems unachievable to me, but just from government behavior. But I don't know. That's I'd be a skeptic. But we will finally only know this number in a year and a quarter, right?
Right.
It will take a long time to play out, and I do think that they are doing things like DOGE like this waste and fraud, they've gone totally radio silent on.
Mm-hmm.
Right. To your point, Besant may talk about it. They are not talking about any Doge cuts anymore, but they're still working on it. So I just have to think something is going to happen. It's just so interesting to me that with the fight with Trump and Elon, that it's become unspeakable.
Yeah, and I mean the fact that they are fighting over this, and Elon obviously cares about the cuts, suggests that things aren't going great behind the scenes on that, or else Elon probably wouldn't be going as aggressive on it as he is. My assumption, but I think it's a relatively safe one. One question here from the live chat that's relevant to this, Jan, asking you to guess a bit, but when do you think we'll see the full effect of the tariffs, and whether the concerns that folks have had about the tariffs are true, are realistic concerns or not?
I think the market has probably priced in 60 to 80% of the tariffs, and what I mean is I think the market's sort of expecting sort of flat increase of 10% tariffs across many trading partners. And the other part is the decoupling with China. I mean, that is really one of the major themes of the first half. So I think the market gets that. I think the Asian markets get that. Whether and how it falls into the inflation statistics, that's why I said we're blindfolded. It's just, there's going to be so much noise. It's such a diverse economy, Adam. It's really hard to know whether we'll ever see anything in the inflation statistics. So I guess that's kind of my point, is it's an uninvestable phenomenon for us.
Uninvestable. Don't try to invest based upon your assumptions there, because
Correct.
There's just too many outcomes. Yeah. So let me just ask you this. One of your bullet points earlier was that corporate profits have been more resilient, more robust so far this year than maybe some folks thought at the beginning, who were worried about this reckoning, right? It does seem on the tariff side, to the extent that there is pain to be had, it seems that the corporations so far are eating it. And of course, they've had these relatively record profit margins. So is there a chance we could get, what do you think is the likelihood we kind of get through this where the consumer doesn't necessarily see a material impact in prices because the corporations just absorbed it?
Pretty good. Yeah, I agree.
Yeah.
I think really hard to see. That's kind of my point. But I've got some good stuff on profitability. So if it's okay if we move on from this.
Absolutely. I'll just ask one question that you can address wherever in the presentation, if it's not already in your presentation, which is, you mentioned, hey, if there's an economic slowdown, like these percent of GDP assumptions go out the window. Would love to hear at some point in here your general, best guess on the probability that we might enter a slowdown or recession in the next 12 months or so.
I mean, I think we are slowing, right? I think we've been talking about that over the last couple of quarters, that the second half of this year will be slightly slower growth. But I think since they're not cutting so hard, we don't have to say the recession word. So slower growth is okay if it's just because we're spending less money at the federal level. So I'd say that's kind of my base case, is slower growth, but nothing crazy.
Okay, very helpful to hear. Okay, well, look, don't let me keep you from the rest of the charts.
Yeah, we'll skip it. The last statistic, just because it's not available unless you kind of have a Bloomberg, is when we talk about the federal budget deficit, I've said, listen, nothing is happening to the 10-year interest rates, right? That's what's really weird. Why are interest rates not worried about our debt and deficit levels? I don't know. So, but we do know gold's rallying, Bitcoin's rallying, and we also know that CDS spread, so this line measures the market's concern about a default in U.S. government debt. And you can see on the left that it spiked during the financial crisis and has been elevated over the last couple of years. Just something good to keep your eye on. But we'll move on. Okay.
Right. Sorry, I got to ask one question just based on what you said there. So you're right, the 10-year isn't running away from us, but it's also not coming down as much, at least as the administration would like. despite, I'm sure, their best efforts to try to get the bond market to start having a little more confidence. So why do you think that's being so resistant?
I think the real frustration for the administration is short-term interest rates. I mean, 10-year is been relatively well behaved. Yes, for housing and other industries, they would love to have it lower. But I think right now what's crazy is we have so much short-term borrowing by the federal government, and short-term rates are kept up, if you will, because of the Fed. And you know that frustration is in the headlines. I guess if you remember the grand bargain that I had talked about, if we had cut a lot of the budget deficit, I thought it would give the Fed room for to cut rates. I'm afraid that we won't get enough bad news. I know this sounds perverse, out of the unemployment statistics to give Powell political cover to cut rates more.
Yeah.
So you just mentioned today we had a good labor market print. In a way, we need bad labor markets for the Fed to cut short-term rates. So I think we're going to be sitting here in 3 and 6 months, and the same thing is going to be happening. Rates are going to be higher. Trump is going to be frustrated, and the labor market's not going to be bad enough to give the Fed cover to cut rates. That's kind of my concern. So, deja vu. I would think in 3 to 6 months, but we'll see.
All right, deja vu all over again. Well, when you're back on for the Q4 outlook, we'll revisit this.
All right. All right. So basically, this is nothing new. AI trend, being transmogrified, if that's a word, into the follow-on effects of higher energy demand, nuclear and natural gas benefiting. And this is stuff that we've talked about. So did that work? Yes, but let's go through the AI phenomenon, stuff that happened in the first half of this year. So this is a chart from Cotu's deck. I don't know if you've looked at it, Adam, but this is I've gotten this chart pack once, I've got it 100 times. This is a deck that they published, Cotu's a money management firm, from their East-West Summit, and it's all over alternative media. But I'll pick a couple of slides. This shows that chat engagement with ChatGPT has exceeded engagement with 2 social media companies. So we're going into this era of, I'll call it, conversational chat, meaning humans are engaging with AI in a back and forth manner, in an iterative manner that becomes a level of engagement. And what you're seeing as well is voice becoming a bigger part of the AI trend as well. Another stat that shows the same thing, this is not from Cotu, but downloads of ChatGPT is magnitudes higher than that of other social media apps.
That's amazing
at this point. So it's really becoming part, and this happened this year, right? So, and Google itself is kind of competing with its own business, right? So they put the Gemini AI response now as the first thing you see with search.
Right.
So what's happening to the last 25 years of digital research for consumers and businesses was to use that Google search bar. That's now completely changing. And the traditional clicking of websites, you can see this is a downward slope, that once people start using AI, they stop clicking on websites, which was really, we hit the inflection point in 2025 is really the point.
So Jan, I got to jump in here because this is so interesting and I think impactful. So Google is starting to cannibalize its own business model to try to get people to use Gemini, its own AI product here, right? Yeah. And that has business implications for Google. But also, Google, what's its share of search right now? It 98% or something. I mean, it's been a monopoly. It's ridiculous that it's been allowed to sustain this for so long. But now you have all these competitors on the AI front. So as consumers start turning to AI for searching, right, for reasons why they would otherwise have turned to Google, how much of a negative or a short does this make Google at this point in time? Like, how threatening is this to Google's monopoly here?
Great question. And I'm surprising myself with my answer, which is super bullish. I guess I'm almost making the case today that AI is so transformative, but also has network effects. So let me talk about that. That these companies could be even a bigger percentage of the S&P. I think we have to open our minds to that, like, because for the last year and a half, we're like, oh my gosh, the S&P is not representative of the economy. The S&P 493, blah blah blah, right?
Mm-hmm.
But let me explain like this sort of network effect. So we actually invested in an AI company in the finance area with the idea of, like, forget Yahoo Finance. Like, people are going to want to do a lot of research using the power of AI tools. So let's pull that data together and combine all the search engines and create a great vertical solution. And you know what? They can't do it because the network effects of a chat model and AI, chat model is the more traffic, the better the model gets.
Mm-hmm.
So because they have the traffic, the Perplexities, the Geminis, they will win in any vertical, right? Because they will always get more traffic than any particular solution. Now, I'm not saying there won't be a lot of winners in AI, but you literally have the same network effect. So I think what Google's doing by cannibalizing itself is brilliant. And they are probably pretty smart, Adam, about when they decided to do that. And the fact that they really implemented that this year, shows me that 2025 is really the inflection year for AI becoming the new paradigm of how we engage with things.
All right, I think I totally get that, and that's a great answer. Let me just ask my question one slightly different way, which is, I can see then the Magnificent Seven becoming the Super Magnificent Seven, right? Because of this AI. But do you see potential for Google's share within that Super Magnificent Seven to shrink because there are other big competitors now that work well, the Perplexities, the ChatGPTs, the XAIs?
That's already happened, right? I agree. The question is, do you want to buy or sell Google stock, Alphabet? And I'd say I'd still want to own it, net, right? Market share down, but profitability. And let's get to that. So this is my favorite go-to slide. Very simple. It's headcount at Microsoft. And that basically shows, it had to grow its headcount. ZIRP is a zero interest rate, kind of economic era that we lived in. Then there was this sort of rationalization started by Meta, arguably, of layoffs in tech or not adding to headcount. Then you had the AI era where they added to headcount. But now we've started this downward slope. And literally yesterday, Microsoft announced new layoffs. They had some in May. And a number, today's Wall Street Journal, actually, so I kind of added this at the last minute. CEOs are talking about layoffs and reduced headcount. So forget maybe the social implications for a second. Think about Microsoft's revenue going up, but its headcount costs going down. That is so incredible for their stock, right? That is really what that's what I'm talking about. Is if that is true for these tech companies to be able to grow, to benefit from AI unquestionably, and to shrink their headcount, man, that is one amazing investment. So anyway, I'm just trying to open this idea that we should own more in our portfolios. I'm not arguing for it. I'm just trying to get people to think about it.
And presumably, Jan, this is not going to be a phenomenon limited to the Magnificent Seven or the Super Magnificent Seven. More and more of corporate America will start doing this as they take advantage of AI, right?
Frustratingly, maybe for small cap investors, right? The bigger scale of a business you have, the better like VanEck, we don't have that many people. We have like 400 people. There's not a lot of people who do the same thing at VanEck. There's very few, right? So it's not like I can take one AI solution and affect 5 or 10 jobs. I just can't. But when you're running a huge bank, like JP Morgan is quoted here, or any large institution, there are repetitive jobs where you can make them more efficient. The head of Ford is one of the quotes that we're going to lose half of all white collar jobs. But anyway, one indicator of that, I don't know if you've seen this chart, Adam, but it's 25% of MBAs, or up almost 25% of top tier MBA schools have their graduates without a job 3 months after graduation, which is higher than during COVID. So we'll see, but I would argue that the MBA is the quintessential white collar worker that is being cut out of the labor force, or shrinking as a part of the labor force.
Yeah, I'll reserve this question for the end for the Q&A, but this begs the question. We already have a K-shaped economy, and there's a lot of frustration and concern that the vast majority of people are beginning to fall further and further behind. This just seems like it's going to kind of put fuel on that fire, which is it's going to make the big companies more profitable. They're going to need fewer workers, so there's going to be more people out of work, and the rich people who own shares in these companies are going to do great, but everybody else that doesn't own a lot of stocks is going to get left even further behind. Do you share that concern? And I'll take the detailed answer later on.
I do not share that concern.
Oh, great. Okay, I'd love to hear positive on that.
I am a techno optimist, because if you look at the U.S. labor force, it's basically a very unmovable line. If you look at it, I wouldn't show it because it's so boring. and there's been such huge technology shocks and other shocks. So, for example, 40 million women entered the labor force after World War II. Mm-hmm. I challenge you to look at a labor chart and figure out how that affected unemployment. Just didn't. So that's why I said we're blindfolded when it comes to these unemployment statistics, because there's so much stuff happening in a diverse, dynamic economy like this, right? So we're about to talk about another trend that's creating job growth, which is the expansion of our electricity grid. So let me move on. Just allow some time for Q&A. Sure. So AI is a big thing. Last thing, venture is still chasing AI. I won't talk about it anymore. Okay. We have to look at how to make money out of this. So I'm going to do a little self-pat on my back. In April 8th, when we were last together, I thought that growth had corrected enough, that semis were a buy, and NVIDIA's up 64% since then. Okay, I do make a lot of mistakes, but I just did want to point that out. The chart on the right shows that the valuation of NVIDIA is much better behaved. So not a reason not to be invested in this trend right now. So I think that's important. But let's talk about something more interesting, which is the second phase, I'll call it, of AI. And big events happened since you and I talked with respect to nuclear power. So the Trump administration said that they want to take that blue line, which is U.S. today is a leading producer of nuclear powered electricity, and quadruple it. They want to take that blue line and move it up 4 times. And I think in the context of the U.S., that seems insane. But I think what's in the back of their mind is China is going full speed ahead in terms of a conversion to nuclear power.
Yeah.
And so if I had one thing that the administration and the industry has in their head, is we have got to do a lot to bend that blue line up. And so I believe they're starting to do it. My favorite factoid, probably from Q2, is Constellation Energy, which is, kind of lengthening and expanding 3 Mile Island, what we know as 3 Mile Island. They're going to get that third reactor going a year ahead of time. Adam, we've never said that in the last 50 years, that a nuclear plant was ahead of schedule. I mean, literally, if I told you that, you'd stop interviewing me. Like literally, it was so incredible. So I'm just saying that things are changing dramatically because of policy, and it's paying off in our portfolios. Mm-hmm. So if you took a diversified index of the nuclear industry, if you include uranium miners, the new SMR manufacturers, and the utilities that are leaning into nuclear, you've made a bunch of money this year. So it was a little bit of a risky call, I would say, because it takes so long to get nuclear reactors going, and we risked a lot of disappointing quarters for the publicly listed companies. But it's paid off. I'm literally, these themes have been the biggest winners in portfolios. And then the last thing that we talked about, sorry, the title is not very descriptive, but this is a natural gas company that also performed really well. Why? Because the demand for power, the nuclear power plants aren't going to get ready soon enough. The demand for natural gas is going to go up, and that paid off as well. So going to pivot into another area of winners, which is international, but I'll pause here to see if you have any thoughts on kind of the AI revolution.
I guess my only question here, Jan, is, especially on the energy side, is this a trend that you expect to continue for quarters/years, given how critical incremental energy production is to power AI in the future?
Great question. I think the trend is powerful. I think the stocks are probably ahead of themselves. So, I mean, I'm not selling, our positions, and we include these in some of our model portfolio solutions, but not adding.
Okay. When you say the stocks are ahead of themselves, are you talking about the energy stocks or the AI stocks, or both?
I would say definitely nuclear. I think the semis are actually okay. The Nvidias and the semiconductors. I just think this chart just feels like it could take a breather.
Yeah.
And now, I bet in the first half it wouldn't take much of a breather. So there were people that were very skeptical, that had been burned by prior energy cycles, who would have been sellers in December. And you can say that it took a lot of courage to hold on during that, I'll call it post-tariff tantrum dip there in April. So there was some blood, sweat, and tears around there, but they had a fantastic quarter of earnings, and so there's enough traction internationally with these selective projects that the hyperscalers are pushing, that I don't think you're going to get necessarily a huge new buying opportunity either.
Okay. And obviously that's sort of in the near term. One of the reasons I asked this question, there's a chart, I don't have it handy, that's been making the rounds recently, that shows China's electrical power capacity, production capacity, and it just dwarfs countries like the US and Europe and whatnot. And it's on this hockey stick raise right now. And of course, access to plentiful, cheap electricity is going to be a huge part of who wins the AI race. And so that's why we're getting all this policy that's all of a sudden super nuclear friendly and friendly for drill baby drill and all these other different programs, or we're going to rebuild the grid here. So it seems to me you're saying, hey, look, and maybe these stocks need to take a breather. They're richly priced right now, but this is a tailwind that probably is going to last for years, correct?
Yeah. Great. And I got more on that for you. So let's turn to international investing, and hooray for diversification in the first half of this year, right? So you can see here that international developed index is up almost 20%. Emerging markets are doing well. Emerging market debt's doing well. So I just wanted to touch on this, but again, what happened in the first half of this year that's transformative? So just historically, we know last decade has been a lost decade for emerging markets. You can see the red line at the bottom. My favorite country by far is India. So I'm going to give you a couple of things about India and a couple of things about the Mideast. So this is my favorite chart, just showing in 10 years, the Indian economy is going to be the fourth largest consumer market in the world. It's going to, I think it just in the first half of this year became the third largest economy in the world. But as compete against all of continental Europe, it's got a ways to go. But okay, quick up to let's combine some themes. So here, what is the country that is the biggest user of ChatGPT? It's India. So we've talked about this digitization trend, and it is literally part of the global economy. It's completely plugged in. It doesn't have a lot of hyperscalers themselves or the big data centers yet, but they're plugged in through the knowledge economy. Let me just show you, I talked about the digitization trend in India and how that can play off. Here's a company, I won't get into details, but it's sort of like, it's an online insurance company for life insurance, and they're now pivoting into other kinds of insurance, property and casualty. You can see here, with plugging into the large Indian consumer market, it's growing its revenue at 50% a year. So, not going to dwell on too much. All right, there are also losers. So this is a company you probably haven't heard of. I hadn't either until my colleague pointed it out. It's called Asian Paints, and you wouldn't guess what it does. It is a paint supplier. But like a year ago, it was a top 20 company in India. And this is why understanding these digitization trends are so important in every country, right? To think that, India is living in a world that's 40 years ago, that's just not true. So this company in particular is seeing its revenue decline because it has the old business model of thousands of distribution points around the country, very inefficient because of, again, the digitization of the consumer and a move to more of a Home Depot, Costco kind of economy, a long ways to go, but the beginning of that. Mm-hmm. And you can already see how an incumbent here, its market cap has almost fallen in half. It's gone from 39 billion to 27 billion. So it's playing out real time in the equity markets.
Wow.
Anyway, just a couple of reminders. India is expensive. This is the PE ratio. It's in the 20s. I don't say ignore that. I'd be aware of it, but India doesn't tend to become cheap, like 10 times earnings cheap. There was a dip. That's when you want to buy it. I think it's not crazy to add here, but that's it on India. Now, what I really want to talk about, because this is what a question you had, Adam, is where cheap energy is going to be super important. And I would say two huge things that happened in the Mideast in the kind of over the last year, the last 6 months, right? One is the marrying of the U.S. and AI to the Mideast. So the Trump administration has been very friendly to the Mideast. Saudi and the UAE, those countries are pouring money into AI data centers because they have the cheap energy. You don't need to have a data center near your Home Depot, right? You can crunch algorithms anywhere, and they are taking that competitive advantage and leaning into it heavily. And the U.S. has basically ensured in the first half of this year that they're going to be using U.S. technology, right? NVIDIA, all the hyperscalers. Trump did a big trip over there. I was in Dubai earlier this year, and I was like, really, I don't need another country to visit in my life, Adam. But I have to tell you that it's the human capital, the intelligence of the investment community, and the depth of it is really tremendous. So that's point number one. I mean, obviously, sorry, just to put a pin on it, they're going to explode their data center capability. It's not even, it's sort of silly. It's 60% a year, but it's sort of silly to put a percentage on it. But on the right-hand side of this prior slide, like you just have to point out how political risk in the Mideast, whether you like it or not, is much lower than it was a year ago. Right? With the actions in the Gaza Strip, in Lebanon, in Syria, in Iran, it's like we forget all this stuff very quickly because it fades from the headlines. But that's really a positive for the region. And I've said before that the Mideast is a very important part of the global economy. And I think that continues. And we've had very positive developments in the first half of this year that I think are worth it in our review.
All right. Hey, two quick questions on this, just long term. So I've raised this question recently on my program, which is, who knows if all this is going to happen? We don't know for sure, but just assume it does for a second, that we now have, a cessation of it seems like a cessation of military action between Israel and Iran. And Iran may be in a position right now where it needs to compromise or capitulate. Who knows? Maybe there's even regime change in there. Don't know. But the question is the door looks like it's more open than it's been in past decades for Iran to become less of an antagonist. And maybe if things go great, Trump style, we come to some agreement, we stop sanctions, we start investing in the country because they're playing ball. Similarly, there's a ceasefire proposal between Israel and the Palestinians, where some other Arab nations might come in and start administering Gaza instead of Hamas. So let's just imagine the world for a moment where the Mideast stops becoming this hotbed of friction, and all of a sudden starts playing ball, and it really starts to let commerce flourish in a way that hasn't been available for the past couple of decades. How big of a game changer is that?
I mean, I already think that commerce is booming, and it's with a high degree of conviction that it's going to be in Saudi and the UAE, because like it or not, they have political stability. There's no question about who's going to be in power in Saudi next year, right? So these economic policies are set for a decade or two, given the youth of the leaders in those two regions in particular. So I think the capital, they've been using technology and the capital markets, right? Saudi took Aramco public because they wanted the discipline of the capital markets, and they're availing themselves. So I think that trend started 5 or 10 years ago. UAE started reforms 20 years ago, and it's really hitting their stride and inflection point where they are able to participate in the world's leading technologies and industries, like not as an afterthought, but as a major player. And they're also a huge capital investor into this industry in the US. So I think on the margin, listen, I want to acknowledge on the political front that people are extremely unhappy, behind closed doors with some of these, sort of developments from the Israeli military. But I'll just take it. It is what it is, for an investing perspective. And to take your point, I think there will always be those political tensions between Iran and Saudi. But if they don't have a credible military threat in the short term, it's a little bit less relevant. And yes, I think will Iran re-enter the global economy? I don't think that'll have a major effect on anything. I did write down in the lower right here, Russia losing Iran hurts it on the margin with respect to its military, because Iran had been making drones. But I guess Trump, if the Hormuz Strait is open, China will continue to buy Iranian oil. Whether we like it or not, whether they're sanctioned or not, and we could all be blood brothers again, and that's not going to change. So we in the United States are much less we're not dependent on Mideast energy at all anymore. Remember, we're kind of we're net neutral on energy, relatively speaking.
Yeah. Okay. So it sounds like the punchline to all this is just it's already game on there, and it sounds like something you would say, look, as an investor, this is something you should consider having exposure to in your portfolio, because it's going to continue to be a big trend. Yeah.
I mean, look, I think a lot of U.S. investors could ignore the non-U.S. markets, and I think in the first quarter of this year, we said, okay, inflection point hit. You want to own. You do want full market exposure. You want international equities. You want emerging markets. And let me just to focus on one thing in particular. So, which is the weakness of the dollar. So if you looked at local currency emerging market debt, so these are countries that have lower budget deficits and much better monetary policies than the U.S., right? Why are their currencies weak? This looks horrible. So if you pull up a chart of an index, of just a price index, you're like, this has got to be one of the worst investments. Why is Jan even talking about it? And one of the things that people are forgetting when they just pull that chart up, Adam, is you're missing the interest rate that you're getting on those bonds. Mm-hmm. So I took the very same chart of the price movement of let's say an ETF or an index but you have to remember you're getting paid 6 to 7% a year. If you look at it that way, it has not been a money loser. And in fact, you've made good money this year on emerging market debt. And we're seeing inflows into those investments as people kind of diversify their fixed income portfolios. So it's historically been something that's worked over a 20-year time period. Again, it looked pretty ugly for 5 years, but I think it's changed. And this is kind of my favorite chart, but no one will ever believe me, no matter how often my colleagues and I show it. But emerging market debt is actually outperforming U.S. debt. So again, just taking a blend of their dollar debt and their local currency debt. And guess what? The bonds of people who start out paying higher interest rates, but actually are running better policies, are performing better. So I am almost done with my observations here.
No worries. This is all great, Jan, so don't worry about it.
All right. So just two quick kind of coda tidbits. So, VanEck has been into crypto since 2017. We're first ETF company to file for a Bitcoin ETF. We at VanEck have an early stage venture fund. We hired Circle's venture team. So we followed this space closely and talked to a lot of people. And I will say that stablecoins are really probably going to affect the bottom line of big consumer-facing Web2 companies like Uber. The CEO of Uber, Dara Khosrowshahi, talked about it. But anyway, we'll leave that whole thing for another time. I will just say Circle's IPO, they went public at 30, and I'm calling this a quasi-meme stock, and I just think it's way overvalued. It's got something like a PE ratio of 86 times. So I would not, I would be waving a yellow flag around this. I like to add in, if people haven't seen my interviews with Adam before, sometimes just some sort of tidbit ideas. This would be, I guess, a tidbit short if you had the nerve to do it. And a company I absolutely love, but I think needs a breather as well. One of the most interesting, I would say, and impactful financial services companies today, probably the one, is Robinhood. They're kind of the new Schwab. What I like to say, the reason we have confetti around it is they make investing fun. And they're leaning into prediction markets. They don't do sports betting yet, but think of that kind of fun experience that people want. Not, I'm trusting you with my money, but I want to have fun with this financial app. And they're globalizing and leaning into crypto and really grabbing the younger generation. But when this chart looks like that, and I'm long, I don't know. I'm raising a little bit of a question mark. So, in conclusion, a very impactful, even though a lot of macro statistics are hard to figure out, and I wouldn't bother. Our portfolios have really been benefiting from a hedge against the U.S. budget deficit. Probably need a pause, but I would not sell out of those hedges to your portfolio, especially because they've been working. AI continues to benefit portfolios if you have a holistic view of not just owning the Mag 7 and the semiconductors, but also some of the downstream beneficiaries like nuclear power and even indirectly nat gas. The Mideast markets, by the way, we didn't even talk about their stock markets, but they are also benefiting from AI, and they barely budged during the Israeli-Iran conflicts. Amazing, really kind of to see how the markets saw through all those bombs dropping and said the underlying trend is pretty interesting. The stat, I should have mentioned this before, 75% of Dubai's economy is not linked to oil. Oh. So it's just a region now.
Right. We think of them as a one-trick pony, but they're really not. Yeah.
Really not. And then just how AI and digitization are affecting stock markets globally. We looked into the Indian market, which is kind of one of my long-term favorites. And even there are winners and losers. So, think about what your exposure is. And then we just talked about one asset class that you might want to consider for your fixed income portfolios because the dollar is weakening and may not, weakened really dramatically during lots of things, including, when we got involved with Iran. You would have thought, oh, this is a typical time for treasuries to rally strongly and the dollar to strengthen. Didn't happen. So we're in a new era, I think.
Wow, what a great presentation, Jan. Thank you again. It's such a privilege to have you come on and do this every quarter. So helpful. And of course, the comments in the live chat here have just been incredibly complimentary and thankful of your efforts here. So folks, I will pull up some questions now here from the Q&A. Jan, before I get there, let me just ask you this. So what I take from this most recent presentation you've just given is the trends that you've had on you placed on our radar are still doing pretty well and likely to continue to, but valuations seem relatively rich in a lot of them right now. You said gold could kind of go sideways. I did hear you say you think Bitcoin could hit a new high in the latter half of this year. Sounds like things like with India and some of the AI stocks, again, while the long-term trend looks really good, it doesn't seem like there's a lot of deep discounts out there right now. So in terms of looking at this from just an investor standpoint, is it kind of like hold through this and just let things consolidate? So don't sell out, but stay in the trade. Or am I taking the wrong message from this?
Yeah, I think just slight tweak. I love India. I love India. I don't think people should think of it as like a 1.7% country to invest in. I just think it should be a tactical overweight because it's done all the reforms and it's got a clear guide path and it's never going to be cheap. So I'm just saying within that market, I wanted to give you a little bit of a flavor of how it's being affected by technology, just like everyone else. But I would say India is a good solid buy. Semis are a good buy. I do see froth in the crypto stablecoin kind of individual investor Robinhood space, and I do see a little bit of froth, a related froth, I think, in a way, in the nuclear space. Even though I really like it as a beneficiary of AI.
Okay, great, fantastic. All right, well, folks, look, I'm going to start pulling up some questions from here. Here's one. What are the prospects for Chinese stocks, Jan?
Yeah, we talked about that. I think in the bucket of this, the last section, they were very hated. We are actually overweight China a little bit. We thought sold off a little bit too much. Their Mag 7 are benefiting from the same trends. They have access to AI. They're going to deploy it, and they have the economies of scale. So like the Alibabas, the K-Webs, not our ETF, but that kind of stuff. I still like it. Started nibbling about a year ago, and would still a little bit disappointing, I would say, but still own it.
Okay. Mark Gator here asks, if there was no crypto, what would the price of gold be? I guess this is sort of asking how much of gold's lunch has crypto and Bitcoin been stealing?
I think gold would be literally the same price. I think what's really got hurt was gold stocks, because the buyers of gold are really, it's a de-dollarization. It's really a look for a second good global reserve currency, right? Just not to over-index on history, but gold underpinned the banking system for the entirety of history. And then we had this weird thing that happened after World War II, where the whole world looked to the dollar to be the sort of holder of gold. And then in 1971, we delinked from the gold standard. So now we're in this paper money era. But I think the world wants the security of an asset that they can hold themselves and is limited in supply. And I feel like we're still early innings of the gold bull market. I think Bitcoin and crypto they're the more speculative, fun asset, if you will. And gold shares used to be the fun asset. Gold shares used to be valued at sort of 30 to 40 times earnings. Those days are long gone. They had to really earn themselves in the minds of investors. But I think that got cleaned up a lot this year. You'll see they basically did a 2-to-1 gold shares against gold. So I think it's, and I think we lost $3 billion out of our gold share ETFs. I think a lot of that was short covering that went away. So I think we're still early. To me, the U.S. investor is hardly involved in gold, so I think we're still early days. But I do think globally, the world wants a second reserve currency, if you want to call it, besides the dollar. And so I don't think bullion buyers have been hurt by crypto.
Okay, and clearly, the central banks have been increasing their purchasing of gold over recent years. So it seems we kind of know the answer to that question, right? Which is, what's the reserve currency they want instead of the dollar? Well, it's gold, right?
100%. Yeah.
Yeah. I just have to ask this because it has had a breakout recently. Do you have any opinion on silver?
No, I don't. I don't have a feel for silver. Obviously, it's sort of more of an industrial metal, and I like to point out that throughout the existence of gold, there have been the other precious metals, silver, platinum, palladium, that have played different roles in portfolios over time. But no, it's kind of cool that it caught up recently or showed some life. But that kind of supports my overall call. I don't have a view on silver, but I would say that it feels to it's another confirmation point that we're early innings in this sort of gold market.
Okay. I guess I'll just ask this as well. If gold takes a breather here, does that mean the mining stocks take a breather here too, or can they continue to vault higher even if gold trends sideways?
I mean, they're a little bit linked at the hip, but I just feel like I showed that gold is so much ahead of its 200-day moving average. It's just a little elevated.
I totally get it. I mean, look, I've been really enjoying the ride, but nothing goes up in a straight line forever, right? Yeah.
Yeah, we're not complaining, and I don't think we're selling. It's just like, things don't go up like that forever.
Yeah. All right. Let's see here. Zenkai asks, how exactly will boomer-aged Americans, let's also lump Gen X in that too, who take up a large majority of the labor market, how are they going to reassimilate into the labor force when AI takes their jobs, or let's say if AI takes their jobs in the coming 2 to 3 years? This is the question in rebuttal to your earlier point of like, hey, I'm not worried about AI displacing a whole bunch of jobs.
Yeah. Well, I mean, listen, with every technology, there's been retraining. I mean, there used to be people, if I called you on the phone, that would plug one cable into another cable to connect us.
Yep.
Right. Thank God that job is gone. Right. So I think, listen, a lot of training happens in corporate America. I guess let me put the positive spin on it. Yes, corporations are sometimes ruthless about cutting costs, but they are also retraining their workforce all the time and investing in new technologies. At least we do. Mm-hmm. And so I guess that's a mitigant for the concern that was expressed there. But we have to, like, I'm a boomer, like I have to work twice as hard, right? To get into that digital world. I have to set aside the time and I have to break some of my dumb habits, right? But I think employers the market will force that. But I'm not saying there's no transition. There is, but there's transitions with all technologies. So there's winners and losers with all technologies. We study history with our summer interns. For the last 200 years, I could list you 20 technologies that have caused a lot of unemployment.
Yeah. I'm going to ask this question anyways. Something I mentioned on the channel a lot, but I'd love to get your opinion on it. Keynes, the economist, talks about a concept called technological displacement, which says if technology can do the job better, more effectively, more cost efficiently than a human, it should replace the human. He said, what you got to watch out for, though, is the pace at which you displace that labor. That if you're displacing the labor faster than you're repurposing it to other constructive use, you can create a social crisis, the cost of which is greater than the savings you're getting from deploying the new technology. And I think some people have this concern that AI could displace jobs at such a fast rate that we're not finding something else productive for these people to do. And we create this sort of big underemployment or unemployment crisis that takes a lot longer than we'd like to resolve. It doesn't sound like you share that worry.
I mean, I will just talk about a sector around which I know almost nothing, which is healthcare. I am dying for AI to be deployed more in the healthcare sector. New treatments, get accelerated because all of us know people who have suffered from diseases or died. That it's tragic, right? It could have gotten way better health outcomes with newer technologies, and just the idiocy of how I interact with the healthcare system. I went to see my doctor, it's part of a healthcare group. I forgot to make an appointment, or I made an appointment that I'm in vacation, I forgot, whatever. So then I called them the next day to remake the appointment. The next appointment was next January. I'm like, that's not true. I just made an appointment for August. Oh, well, to do that, you have to call a separate number. I'll leave them a message and they'll call you back. And then they call me back on my cell phone. I'm dying to get that call just so I can make an appointment for a month or two from now. I mean, that's just insane. I can't wait for AI as a consumer of healthcare, right, to improve our lives. So I would just say, sure, we as workers have to change how we work, right? And the main point of half of my presentation is we are already changing how we're working and how we're using AI, right? And let's not forget that. So I'm just there's tremendous upside as well. I'm not trying to sound like Pangloss here. I'm just making the point that there's a lot of wood to chop.
Okay, and that there's a lot of, with some of the bad, there's also a lot of good. Don't forget that. Don't lose sight of that. Okay, Jim here asks, what's the highest probability black swan that could emerge? Obviously, if we knew it was a high probability, it wouldn't be a black swan. But I guess the question is like, what are some of the things that you worry about that could derail the system here?
I think the budget deficit is the biggest because it hasn't been expressed through 10-year interest rates, but Jamie Dimon can be quoted as recently as in the last month or two, basically saying expect a breakdown in the bond market at some point. Now he always tends to accentuate the negative scenarios, but that's got to be the number one scenario. I put that higher than most, maybe 20%. It could happen very quickly. My point always with history, looking at history, changes can happen really quickly, and you have this downward spiral, higher interest rates, maybe higher unemployment, even higher budget deficits. Hard to get out of that cycle. So I could spin a really bad black swan. Obviously, some kind of military conflict in Asia. Don't need to kind of articulate that. Would be number two on my list.
Okay. We'll just take one or two questions more, Jan, and then let you get on with your day. You've been so generous with us. Cody here asks, maybe this hits a little close to home. Will AI replace fund managers?
Well, our fund managers are definitely using AI as knowledge workers. It's a great question. So my view of the world is I'm a data guy. What do I mean by a data guy? Algorithms are always algorithms, but what matters is, do you have proprietary data? So the reason I was saying that these large tech companies are winning before is because they have so many consumers, they have so much data, right? Tesla has so much data about driving, it's like blows your mind out. So I look at fund managers as half the time not processing the information. They're not like an algorithm. They're actually generating original data, right? They're meeting with companies where some of that information or suppliers or markets that sometimes is just not easily publicly available. So I would say that if I'm right about conceiving of active fund management as still, searching and generating original data, then no.
Okay. All right. The last question I have for you before we wrap up. So VanEck has a ton of funds for almost anything that the investor might want to get exposure to. But Jan, you have this macro way of looking at the world, which, is sort of, like a portfolio manager, right? Does VanEck have any funds that are managed sort of in the way that you might manage one, given how I think India is going to do well. I think the Middle East is going to do well. I think semis are undervalued right now. Is there any sort of actively managed fund like that VanEck offers?
No, but we do offer what's called model portfolios. So it's basically the ideas I talked about. Our bias is to include some funds that are not VanEck funds. So we don't have the best of everything. And our second bias is to always have some kind of allocation to real assets like gold or commodities. But that's our philosophy, and those models are available through financial advisors on different tech platforms. We're kind of ramping up that availability, so I just say contact a VanEck person, and we can have that conversation.
Okay, and that's a great segue to my next question, which is, so folks want to learn more about VanEck's suite of services, its funds, its solutions. Is it vaneck.com right here that they should go to?
That's it. Yep. Thank you, Adam.
Oh, no. Thank you, Jan. This has been fantastic. So, folks, if you have enjoyed this, please let Jan know by hitting the like button. And also, if you're here in the live chat or watching the replay, just let us know. Make a comment either in the chat or in the comment section below. If you'd like us to continue doing these quarterly sessions with Jan. Jan, I think we're going to get about 100% people saying yes, absolutely, especially given the comments I've seen throughout today, and of course the ones that are coming in right now. But I just can't thank you enough for doing this. It's such a pleasure and a privilege, and I really look forward to seeing you for the Q4 update.
And answer the most important question that we didn't address this time, which is these slides are available through Adam. He doesn't have them yet, but I will send them in the next couple hours. How do they get those, Adam?
Thank you for giving me the ability to clarify this for people. Yes, so just folks simply sign up for our Substack. Just go to thoughtfulmoney.substack.com. Totally free to sign up. In about an hour, I'll be sending out the replay video of this video, plus a write-up about it. And in there will be a link to this chart deck. So you'll be able to get Jan's entire chart deck for free simply by clicking that link in the free Substack email.
Awesome. I'm glad we remembered that. That's always the question I get. It's like, where are these slides?
Yeah, and I love it when a guest of mine, Jan, actually does my marketing for me. So thank you so much. Well, look, we're filming this, on July 3rd. So Jan, have a fantastic 4th of July with your family. Please give our best to the whole VanEck organization. And again, thank you so much for doing this. This is fantastic, and really look forward to doing more of this with you in the future.
Healthy, happy holiday to you as well.
All right, thanks. And everybody else, thanks so much for watching.
Saudi Arabia is now, to my mind, the third government next to China and Russia who are, or maybe let's call it the fourth, India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the Enbridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth, in order to be able to demand physical delivery. This is a privilege retail investors do not have.
Saudi Arabia, while not yet a formal BRICS member despite invitations since 2023, is increasingly aligning with the bloc's strategies. Its central bank has quietly taken a large stake in the SLV silver ETF, big enough to allow physical delivery, a privilege unavailable to retail investors, signaling a growing shift toward precious metals. This move fits into Riyadh's broader strategy of diversifying ties with emerging economies under Vision 2030 while still maintaining Western alliances, highlighting a geopolitical pivot toward multipolar finance and alternative hedges in an uncertain global system. Andy Schectman, the CEO and president of Miles Franklin, reveals that COMEX deliveries and offtakes have surged to record levels. Countries like China, Russia, India, and now Saudi Arabia are heavily accumulating silver, signaling its strategic importance beyond just industrial use. Saudi Arabia even took a major stake in SLV, giving them the option to demand physical delivery, something retail investors can't do. Meanwhile, global accumulation is rising. China is buying directly from miners. India has purchased over 800 million ounces in 5 years, and Russia added silver to its national stockpile. Analysts warn that even a small shift of investment from gold into silver, say 10%, could consume all newly mined global supply, potentially triggering a massive squeeze. At the institutional level, interest is also growing. Harvard's endowment recently bought $101.5 million in GLD, reflecting how mainstream precious metals are becoming. Sovereign wealth funds, universities, and hedge funds are positioning for physical delivery, while the general public remains largely unaware of the unfolding shift. Before we continue our talk, please subscribe to our channel and click the bell symbol to receive timely updates. Have fun watching the video, and thank you.
Deliveries on the COMEX are extraordinary, Elijah, as are the offtakes off the COMEX exchange, which are extraordinary. These are very, very much aberrations. They're anomalies. We don't see them very often, or never have until recently. And I remember talking with your dad in 2020 about all of a sudden all of these deliveries coming into COMEX. They've only increased 100-fold. But when you talk about trends, Saudi Arabia is now, to my mind, the third government next to China and Russia who are, well, maybe let's call it the fourth, India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the M-Bridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth, in order to be able to demand physical delivery. This is a privilege retail investors do not have. They will. I find it interesting. We've talked at length about China flying around the world and buying doré and concentrate directly from the miners in South America and Mexico. We've talked about India buying over 800 million ounces in the last 5 years. We've talked about Russia making it part of their national stockpile, which we'd never heard before from a government. And now Saudi Arabia is doing just that. And so when you realize that India, China, Saudi Arabia appear to be publicly accumulating silver under the guise of industrial uses, it's a lot more than industrial. Silver is really more strategic than it is industrial. Just a 10% shift from gold to silver, where all the people investing in gold, if 10% moved it to silver, it would consume all newly mined silver globally. This is, implying a potential massive squeeze. He said, one billionaire won't do it, but 10 would, or a 10% shift out of gold into silver. When you see governments like Saudi Arabia come into the fray, you know that it's coming. I found it very interesting. One of the things that I talk about a lot when we talk about the public not holding any gold, very little. My standard phrase I copy from Rick Rule. He says, from Joe and Jane Sixpack to the Harvard Endowment Fund, the average of gold owned by the public and gold-related equities is 1/2%. Well, lo and behold, the Harvard Endowment Fund just bought $101.5 million in GLD recently. And so now you have all of these institutions jumping into accumulating precious metals. Now, these institutions, I don't know how much they understand the difference between GLD and the real thing, but you look at Bass, his last name is Bass, I forgot, his Kyle Bass, I think is his name, when he, the Texas Teachers Union, or it was a big fund for that, I believe that's what it was. It was a long time ago, maybe a decade ago, but he put all that money, like $1 billion into GLD, and they took possession of it as well. So I don't know if he intends to do this, or they intend to do this time, the Harvard Endowment Fund. But the very fact that they're buying $101.5 million in GLD tells you that gold and silver are becoming more mainstream, certainly more mainstream. And I think you'll see at this upper level on COMEX, sovereign wealth funds, endowments, that's one step away from the public, who is still kind of blissfully, whistling Dixie, not really understanding the significance of this. But the people who are very, very tied in to what's happening globally are making moves and standing for delivery.
Andy points out that insiders are leading the charge into commodities while dumping stocks. hedge funds and big investors have been selling billions in equities weekly, with major figures like Buffett holding record cash, and NVIDIA executives unloading shares. Insiders selling far outweighs buying, while the public is heavily leveraged in stocks, options, and margin at record levels. At the same time, insiders are accumulating gold and silver, with record COMEX deliveries and the U.S. turning into a net importer. This contrast shows the public is all in on risky equities while insiders quietly shift into hard assets. Historically, insiders win because they have both money and information, positioning early before the masses catch on. We're nowhere near the top because the public hasn't really entered the gold and silver markets yet. Andy highlights that over $100 billion has been delivered on COMEX this year, much of it leaving the exchange, which signals insiders know something big is coming. With interest rates likely to fall, asset prices will rise, but average people without assets will be left behind. Hard assets like gold, silver, and even crypto look set to surge as the dollar weakens and commodities remain undervalued compared to financial assets. Insiders are positioning early because they see the stress building in the system.
Because the insiders, this is how markets work. The insiders always lead the charge. The insiders don't just have the most money. It's not luck. The insiders are also connected to the information. And that's the most important thing. And if you understood the information and you see the people who understand the information moving in a certain direction, well, you should be doing that. I've talked at length over the last few weeks about the contrarian indicator. And let's just go over it once again for the chance that the few people watching this haven't heard me say this ad nauseum. And I apologize for those who have. But on one hand, you have the insiders dumping stocks, the hedge funds, the managed money has been selling between 2 and 4 billion a week since June. Buffett is sitting on between 4 and 500 billion in cash. You have a 7-to-1 selling to insider buying since the beginning of the year. You have the 3 or 4 largest board members of NVIDIA, huge stockholders selling cumulatively over $1 billion in NVIDIA shares. You have Bezos has sold over $6 billion in Amazon since June 1st. You got all of these insiders who have the information selling, right? At the same time, you have the public, which is all in the highest allocation to precious or to equities ever. More so than the great financial crisis and the dot-com bubble, about 54%. But if that wasn't bad enough, they have the largest allocation to margin play, the highest ever, over $1 trillion, and the largest allocation to options. So options and margin signal speculation and leverage. So you have the public all in on leverage and margin. At the same time, the insiders are leaving. But flip it over to the other side. You have the public, as you mentioned, very tepid in terms of their understanding or allocation to the commodities. But what do you have going on the other side? You have the largest deliveries on COMEX that we've ever seen, ever. And the U.S. has become net importers. Who's bringing all of that gold in? And much of it leaving the exchanges. Well, those are the insiders who are closest to the information. So the insiders are buying commodities and selling equities, and the mom-pop public is nowhere near commodities and all in on equities. What could possibly go wrong? And this is what I think people should take away, is that, this is why the big money always wins. They're positioned when no one else has any inclination. And by the time the people figure it out, the insiders have been comfortably positioned for a long time, and they're probably at that point start looking for their next great value that no one else is noticing. And this is why the rich get richer and the poor get poorer, because the rich not only have the most money, they're closest to the information. They know the playbook. Do what they're doing, not what conventional wisdom is saying. We're nowhere near the top because the public has no understanding of exactly what is happening. This has been driven by central banks primarily, and big money, and whoever is taking possession here in the United States. But the public is nowhere near even entered into this at all. So no, I think that, to see a market move the way that it has without the public involved is rather telling. To see, what amounts to north of $100 billion delivered into the COMEX that we know of since the beginning of the year, What does that tell you? I mean, this has never happened before, and to see a lot of it leave the exchange, this has never happened before. And people at that level don't make moves like that unless they know something is coming. And I do believe that. I really do believe that. And so I guess I would say we're nowhere near the top. When you see, like, to your point, everybody talking about it, and everyone having allocation to it, well, it may be time to start thinking about this. But not only that, we're looking at lower interest rates coming, which of course benefit asset prices. And so this locks out average people as far as I'm concerned, because the average people, they don't own assets, and assets are what make the wealthy. Because, you know, as they're going to choose a path of inflation, you're going to see everything pop up. You see stocks, real estate, bonds, gold, silver. All of these things are going to surge, in my opinion, at least at first. Now, what happens with the stock market ultimately is anyone's guess. To see all the people, all the big money moving out, to me, is very dangerous. But I think you will see cryptos, precious metals, those things are going to do very, very, very well. Hard assets in particular will do very well, because these are things that will protect you as your dollar is losing purchasing power. And, you know, commodities right now are historically undervalued related to financial assets. So I would argue they're really the ones that are poised to break out. The system is under stress, Elijah, and it seems that to a degree reality is catching up. That's why the insiders are doing what they're doing. They do it long before the rest of us figure it out.
While the public remains largely unaware, central banks, sovereign wealth funds, and major institutions are quietly accumulating gold and silver, signaling a strategic shift away from risky equities and into hard assets. With record COMEX deliveries, growing BRICS alignment, and insiders positioning early, the stage may be set for a powerful move in precious metals. Those who wait until the mainstream catches on could find themselves locked out or paying much higher prices. Do you think the public will only recognize the shift into gold and silver after prices surge dramatically? Could silver face a historic supply squeeze if institutional demand continues accelerating? Please feel free to express your opinions in the comments section below. If you found this content useful, please remember to subscribe to remain updated and to give it a thumbs up.
I think everything's on the table. We just have to be patient. We have to be appreciative of these prices below $40. I think once it takes out $50, it can happen rather quickly that we rally towards $75 and then maybe $100. And technically speaking, we have the mother of all cup and handle patterns in the silver market. It's a 50-year pattern there in the making. And on a linear chart, we're talking $100 price target. On a logarithmic chart, we're talking $500, $600, $700 price targets for silver. And if we look at the gold-silver ratio, you can also definitely make the case for three-digit silver. These are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years.
Silver supply is limited since little new production is coming online, and most is just a mining byproduct. The speaker believes silver is setting up for a massive move, supported by a 50-year cup and handle pattern. Once silver breaks $50, it could quickly surge towards $75 and even $100, with long-term targets as high as $500 to $700 on a logarithmic chart. The gold-to-silver ratio also points to the potential for three-digit silver prices. On gold, the outlook is similarly bullish, with projections of $4,000 to $5,000 in the near term and the possibility of $10,000 in the coming years, with a shallow pullback to $3,120 presenting a buying opportunity. Demand remains strong in Asia, led by China and India, where cultural and safe haven buying continues to support prices. Hong Kong gold imports surged 127% in July, while China's overall consumption dipped 3.5%, though bar and coin demand jumped 24%. Chinese investors also drove record ETF inflows of 70 tons in 1 month, doubling their share of global ETF assets to 6%. In India, jewelers stocked up ahead of festivals despite high prices, paying premiums up to $4 per oz. Overall, Asian physical demand was robust, with Chinese bar and coin purchases up 44% and Indian demand up 7%. Florian mentions that gold is holding steady amid a softening US dollar and yields. Overbought conditions signal a need for fresh catalysts to break past $3,400, though the metal remains well supported. Major institutions such as Goldman Sachs and JP Morgan forecast gold prices reaching $4,000 by mid-2026, supported by structural rallies and dollar weakness. Pullbacks remain possible if gold becomes overbought or risk sentiment improves. Before we begin, please subscribe and enable the notification bell so you stay up to date.
I mean, here we are, end of August. Everything's a little bit slower. That's totally normal. People should actually spend this time in the summer with the families at the beach or at a beautiful place, taking off and like recharging, right? So nothing to worry here. Of course, last week, the big Jackson Hole event kind of like created some volatility in the markets, but I would not overvalue all these statements. I mean, in the end of the day, it's the price action. The market usually is dictating what the Fed is in the end of the day doing. So we have seen gold consolidating now since end of April, more than 4 months, healthy consolidation on high levels. I think you and I agree that we probably both have expected maybe a bit more of a deeper correction back in end of April when it rushed to that new all-time high at 3,500. But all the market gave us was a low at 3,120. And already that looks like a buying opportunity in hindsight because gold is trading nearly 10% higher. So it's holding up really well. I think it's strongly supported by the physical demand out of China and Asia, of course. But I think also slowly but surely the Western big money, so to speak, is waking up to the fact that gold is the last man standing. And it's a clear bull market in comparison to all the other markets. You have a very strong, clear bull market in gold. And I assume that it's just a question of time until we see the next leg up. Gold is trading in a tight trading range. It's getting tighter and tighter. Over the last few weeks, it's been less than $100. We had some days recently with less than $10, $15 of a trading range. And it doesn't take much for gold to break out. I mean, already 3,400 is already the next probably buying signal here, a pro-cyclical buying signal, if it breaks above that, and it just takes another $5 from you as we speak. So it looks very bullish. It's been holding up very well. It's, I think, the most interesting and exciting market. It reflects not only the things that we just talked about, historically speaking, and when it comes to value investing, etc. But of course, it's also a geopolitical, in-depth kind of story that you can read if you look at the gold price and its development. So I think it's all looking very, very positive and promising for gold here. Usually these consolidation periods end with one little bear trap. You get one little quick nasty sell-off that shakes off all the weak hands, and then the market turns around violently and rallies hard to the upside. Maybe that's still around the corner in September, but I don't see any big downside here. I think I wrote this in Gold We Trust report in May already. I said gold is most likely not coming below $3,000 anymore, and here we are. And it's holding up very well. The only situation where I could see a little bit more of a challenging times ahead is really if the stock market would get into a deeper correction, something maybe that like we've seen in January until March, with a big final panic kind of in the last days of March, early April. But whenever this liquidity suddenly disappears, and then of course gold and silver prices are also affected in the short term, but whenever this disappears, the liquidity, magically a few days later it reappears and shows up again, and then it's a buying spree within a 2-week kind of everything changes, and 2 months later you have new all-time highs in the stock market. And of course, gold and silver is also strongly moving higher. So remember that sell-off that quickly led to silver falling below $30 actually was the launching pad for that 40% rally since then in silver. So it's always this mass psychological phenomenon. It's sometimes hard to time, but usually you can see in the charts more or less what's around the corner. And here we are. It looks like gold is about to break out and move higher. And it doesn't take much to the all-time high. And after that, I think we're moving to $4,000 rather quickly.
Florian points out that we are clearly in a precious metals bull market, but it hasn't reached the euphoric stage yet. Other assets like Bitcoin, tech stocks, and real estate have captured attention, while inflation and economic strain have limited many investors' capacity. Still, with ongoing money printing and global instability, gold and silver are likely headed much higher. Typically, bull markets end with explosive moves where prices double in a short time, and we haven't seen that yet. Looking ahead, continued fiat currency debasement could drive gold toward $4,000, $5,000. Rising volatility is expected, with daily price swings of several $100s possible, similar to past hyperinflationary episodes. The main concern, however, is the push for central bank digital currencies and tighter financial surveillance, which could make it harder to trade precious metals openly and potentially push transactions into black markets. Let's recall the interview now.
Well, I think we are in the bull market, right? So the surprise is clearly to the upside. Usually those bull markets end in total euphoria. I don't think we are there yet at all. I mean, you don't have your taxi driver and your grandma telling you all the day to buy gold and silver.
Your grandfather did.
So I think, yeah, but my grandfather, mom has not called me telling me
All right,
to
right
buy
on.
gold and silver. He just bought. I mean, it's another one for like usually the Joey come kind of late guys. I don't see them moving into gold like euphorically right now. I think there's so much going on in the world of investments and so many other topics. Of course, Bitcoin has taken away a lot from the gold cake over the last 10, 15 years, and the tech stocks. And also, I think many people just don't have as much money anymore because inflation and all these difficulties during the COVID period. It's a complex kind of setup that we have here. But we are in a bull market in precious metals. I think the best is yet to come. Usually at the end of such a bull market, you see that asset doubling within a few days or weeks. That's usually the signal where, oh, now it's really the top. We want to be careful and probably move into something else, but we haven't seen anything like that. I think that the Western world is in such a dire shape that money printing will prevail and even intensify over the 12 to 24 months. And that will push every asset overall higher. So I've been calling this the cracker boom for many years already. And I also described it before a little bit, like you have, in the end of the day, the depreciation of your fiat money is making sure that most of the good assets, or more or less good assets, are rising over time. So your real estate is becoming more dollar in euro. Your stocks, the good stocks at least, or the better ones, or the ones that are being chased through the village right now, are moving higher. And of course, precious metals and Bitcoin as well move higher overall. I think we're going to see a lot of volatility. I think that, and that's, by the way, if you the Weimar Republic hyperinflation, you can see how dramatically the volatility increased in the years between 1921 and 1923. So something like this is very likely, and we probably will then also see $300, $400, $500 swings in the gold price on a daily basis. But we're not there yet. That's why we should appreciate these rather quiet times right now. I think gold is probably on the way to 4,000 and then 5,000. I mean, these are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years, simply because I assume that the money printing, the fiat money printing will continue. And in the digital central bank kind of money that they try to push on us, that's my main worry, actually. And it's very hard what to make out of it, to be honest, because it can theoretically mean that at some point we're not able to buy and sell our precious metals within these currencies anymore, and we have to maybe go back to black market kind of situation. Who knows?
Florian emphasizes that gold and silver are firmly in a long-term bull market, supported by strong Asian demand, central bank buying, and technical setups pointing to much higher prices. While both metals may face short-term volatility, their role as safe haven assets amid fiat debasement, economic strain, and geopolitical uncertainty suggests far greater upside ahead. With projections of $4,000 to $5,000 gold and silver breaking toward triple digits, the next explosive phase of the bull cycle may be closer than many expect. Could central bank digital currencies limit access to physical gold and silver, reshaping how investors participate in the bull market? What technical or fundamental signals would confirm that gold and silver have entered their euphoric, final stage of the cycle? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up, and remember to subscribe for future videos. Thank you for joining us on this adventure.
We're right at the end game. It could happen any month. It could happen in gold. It could happen in silver. I've always thought that it would happen in silver just because it's such a small market. Yeah, it's clearly a breakout. I would think silver is going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper. Even if we got to 45, 50 to 1, half of what the ratio is now, you'd be looking at what? $175 an ounce with gold at 3,500. Yeah. If you got to 50 to 1.
Bill Holter warns that we're already at the end game, and a failure to deliver could happen any month in gold, silver, or even other commodities. And because silver is such a small market, a failure to deliver event could happen at any time. This move in gold and silver looks like a true breakout, signaling a global loss of confidence in paper assets. Silver seems destined to test $50 soon, but longer term it's likely to push well beyond that level. With gold already in uncharted territory, there are no technical ceilings, only the next battle lines ahead. If the gold-silver ratio simply returns to 50 to 1 with gold at $3,500, silver would reach $175 an ounce. Bill Holter, a well-known precious metals commentator and analyst, points out that recently, a big shift has emerged in precious metals delivery. Instead of contracts shrinking between the first and final notice days, more buyers are now standing for delivery, sometimes even doubling or tripling the original amount. This exposes the weakness of the fractional reserve system, where only a small fraction of the metal needed actually exists for delivery. As more people demand physical metal, the chances of a failure to deliver event rise sharply. Once that happens, confidence in the system could collapse, because contracts that can't be fulfilled are effectively worthless. Gold and silver prices have long been suppressed to protect faith in the dollar and the U.S. Treasury's ability to borrow trillions each year. By keeping gold down, authorities maintained the illusion that the dollar was strong. But that strategy is unraveling as major sovereigns are selling U.S. treasuries and shifting into physical gold and silver. This move reflects a deeper recognition. According to Bill Holter, once confidence in paper assets breaks, demand will rush toward tangible value, and the system will struggle to contain it. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
Right, it'll create more demand. And along with creating demand, not just paper demand, you're going to have more and more people buy contracts and then immediately stand for delivery. As a matter of fact, for the last 2 or 3 years now, it used to be, and I'll use silver as an example, it used to be that there were X amount of contracts standing for delivery on first notice day. And then by the time delivery day came, final notice day, the amount of contracts outstanding would have dwindled by 50% or more. Over the last 2 or 3 years, what has happened is you get X amount of contracts on first notice day, and then by the time of the last day, final notice comes, there's more contracts outstanding, and in some cases, there's more than double or triple the amount of contracts that were standing the first day. So you have buyers that have been coming in and immediately standing for delivery, and that's the Achilles heel to the fractional reserve system. I mean, there's no question. I mean, even the powers that be will admit, yes, it's a fractional reserve system. We really only have 5% or 10% of the metal or whatever it is available for delivery because not everybody stands for delivery. Well, we're at the point now where there's more and more understanding that because it's fractional reserve in nature, it will ultimately fail to deliver. And again, the psychology of human beings, when they're told they can't have something or they might not be able to have something, they want it even more. And it's going to cause a stampede of contracts standing for delivery, and that'll be your failure to deliver, which blows up the entire system, by the way. Because if you've got all these contracts that are actually worth zero because they cannot perform, it breaks confidence. And the reason, let me back up a little bit. The reason gold, and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing. I mean, we have to borrow $2 trillion a year just to balance the books, just to keep the system afloat. So they suppress the price of gold and they'd whack it. I mean, you remember, go back, 10 years ago, 15, even 20, 25 years ago, gold would start to pop its head up and they'd whack it, 1%, 2%, 3%, which back then when gold was $300, $400, a $10 move in gold was huge. And it was demoralizing to see all of a sudden gold was going higher and boom, they smashed it. Well, the reason they smashed it was because they want to be able to point at the price of gold and say, see, gold bad, dollar good. And that allowed the confidence for the rest of the world to buy treasuries and fund the U.S. deficit. At this point, that's starting to unravel because you're seeing some very big sovereigns liquidating U.S. treasuries and turning around and replacing that with either gold or silver.
Bill Holter explains that gold's rise over the decades isn't just about a bull market. It reflects the steady decline of paper currencies since the U.S. left the gold standard. The dollar index may look stable against other fiat currencies, but the real measure is against gold and silver, and in that sense the dollar has been steadily losing value. Authorities have even considered gold revaluations in the past to reflate debt-heavy systems, highlighting the constant need to fight deflation with inflation. Today, as debt burdens balloon, the same pressure is building again. Governments must inflate or die. At the same time, silver stands out as the most undervalued asset. Historically, silver traded around a 15 to 16 to 1 ratio to gold, close to its natural supply ratio of about 10 to 1. Yet today the ratio sits near 85 to 1, even spiking to 120 to 1 in recent years. This massive gap signals extreme undervaluation, with silver priced far below its historical and natural balance. Bill Holter summarizes all the above discussion by highlighting that combined with its essential uses in industry, medicine, and technology, silver's position today suggests enormous upside potential once the market corrects.
I mean, this has been going on. It's been going on and on and on. I mean, we've had a bull market, if you will, in gold. But the reality is it's been a bear market. It's been a diluting market in the dollar and other currencies ever since we went off the gold standard. I would think if the dollar should be bouncing and bouncing pretty hard right now, it's not. And what won't go up must go down. So I think there's another leg down. But again, I don't think the DXY is really a good index to look at because you're looking at dollars versus other paper currencies, the euro, the yen. The true measure is versus gold and silver. And that verdict is already in. Right, because gold was $20.67, and then they revalued. They took everybody's gold and they revalued it to $35. And that, there's a lesson to be had there. When they revalued gold from $20.67 to $35, that started to break the back of deflation. It was an inflationary event. And I mean, there's all kinds of talk wherever you look now about a gold revaluation worldwide. Well, what is that telling you? It tells you that they're desperately trying to reflate the system. And they have to reflate the system because of the amount of debt that's outstanding. And it all goes back to the late, great Richard Russell, inflate or die. I mean, in this system, we cannot have deflation. You cannot have deflation of assets because everything is held up on margin. And when assets deflate, you get a margin call, then the entire system comes down. And basically currencies become literally worthless because they're based on the full faith and credit of the issuer. And all of these issuers, from the United States to all the Eurozone, I mean, they're all bankrupt. They're all upside down and insolvent. A lot of hedge funds and family offices, they're knowledgeable. Not all of them, but a lot of them have been buying the physical metal.
I see.
Now, that said, I can say that for the last 9 months, even close to a year, the demand for physical metal out of North America has collapsed. But yet the price of gold, I mean, if you asked me 5 years ago or 10 years ago, is there any way gold could be, could run from 2,700 to 3,500 and North America be a net seller? I would have said no way because, it would stir up the greed factor. But what you're seeing is liquidations out of North America and whatever. I mean, I've gotten more sell orders in the last 9 months than I had cumulatively in the last 15 years. And I asked people, why are you selling? And I've only had maybe a couple, 3 people tell me, well, I'm going to take a profit. And I asked them, well, where are you going to put the money in a system that's going to mathematically collapse to keep it protected? And they're like, oh, well, when gold drops or silver drops, I'll go back in and I'll rebuy it. Well, good luck with that, because when there's a failure to deliver, there won't be anything to be had. And if you're not on the bus, you're off the bus and you can't get back on the bus. But the vast majority of people that I've asked have all said, I need the money. I need it to live on. So it tells me that the money on the streets in North America is evaporating or evaporated. Right, but they are both strategic metals. I mean, think about silver. Think about all the uses that silver has. Medicinal, industrial, technological, monetary. I mean, there's so many uses for silver, and it is, in my opinion, silver is the most underpriced asset on the planet.
Mm-hmm. Now, going back,
and I say that because, Danny, gold. The reality is, gold is the measuring stick. We got fooled. The world got fooled for 50 years that the measuring or more that the measuring stick was the dollar. Everything was measured against the dollar. How many dollars? The reality is dollars themselves are measured against the ultimate measuring stick, which is gold. Yeah, and the reason I say silver is the most undervalued asset on the planet, I mean, for how many hundreds of years, and even in the U.S. Constitution, the ratio is 15 or 16 to 1. You could go back 1,000. Well, first off, silver comes out of the ground just under 10 to 1 to gold. So there's roughly 10 ounces of gold pulled out of the earth for every 1 ounce of gold.
1 ounce of silver.
That's God's ratio. Right. 10 ounces of silver for every 1 ounce of gold. Now, for hundreds of years, the ratio, the price ratio was 16 to 1. And the reason being, back 100, 200, 300, 500 years ago, in order to transport money, you had to transport gold or silver. But if you transported silver, you had to transport 10 times the amount of silver to get the same capital. So man discounted the silver price to 15, 16 to 1 to account for, the extra carts or carriages or whatever that you needed to transport silver.
In short, both gold and silver are flashing signals of deep cracks in the paper-based financial system. With debt loads soaring, currencies weakening, and physical supply inelastic, the pressure is building for a major repricing of precious metals. Silver, in particular, looks poised for dramatic gains once confidence in paper assets fades and investors rush toward tangible value. If a failure to deliver event occurs in silver, how quickly could it spread to gold and other markets? Could a government-led gold revaluation be the trigger that finally resets the global financial system? Share your thoughts on Bill Holter's analysis in the comments section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.